Topic examines transaction and non-transaction deposit types, which are fundamental funding sources for banks and financial institutions. Transaction deposits are accounts that allow frequent withdrawals and payments, including checking accounts, demand deposits, negotiable order of withdrawal accounts, and electronic transaction accounts. These deposits provide customers with liquidity and payment convenience, making them essential for daily financial activities. Because transaction deposits can be withdrawn immediately, banks must maintain sufficient liquidity to meet customer demands. Non-transaction deposits, in contrast, are primarily savings-oriented accounts such as savings deposits, money market deposit accounts, and time deposits. These deposits generally offer higher interest rates in exchange for reduced liquidity or withdrawal restrictions. The topic explains that transaction deposits are highly important for banking system stability because they represent stable and relatively low-cost funding sources. Retail transaction accounts are often considered core deposits because customer relationships and payment needs make balances relatively persistent over time. However, these deposits may still fluctuate during periods of economic uncertainty or declining confidence in financial institutions. Banks therefore monitor customer withdrawal behavior, account concentrations, and seasonal cash flow patterns carefully. The topic highlights that transaction deposits contribute significantly to liquidity management because they support lending activities while reducing dependence on volatile wholesale funding markets and short-term institutional borrowing arrangements. Non-transaction deposits differ from transaction deposits primarily in their liquidity characteristics, maturity structures, and pricing behavior. Savings accounts and certificates of deposit generally provide more stable funding because customers accept restrictions or penalties associated with early withdrawals. Time deposits, in particular, offer contractual maturities that improve funding predictability for banks. However, non-transaction deposits are more sensitive to interest rate competition because customers may transfer funds to alternative investments offering higher returns. The topic emphasizes that banks must balance deposit stability, funding costs, and customer preferences when designing deposit products. Maintaining diversified deposit structures helps institutions strengthen liquidity resilience and reduce concentration risk across funding sources. Topic also focuses on methods of pricing deposits, which directly influence customer behavior, funding stability, and institutional profitability. Deposit pricing involves determining interest rates and account terms offered to depositors while balancing competitive pressures and funding objectives. Banks consider market interest rates, liquidity needs, operating costs, customer relationships, and competitive conditions when setting deposit rates. Transaction deposits often provide lower interest returns because customers value liquidity and payment convenience, whereas time deposits and savings accounts typically offer higher yields to attract longer-term balances. The topic explains that effective deposit pricing supports stable funding growth while helping institutions manage interest rate risk and profitability objectives simultaneously. A major aspect of deposit pricing involves relationship pricing and market-based pricing strategies. Relationship pricing rewards customers maintaining multiple accounts or long-term banking relationships by offering favorable rates, fee reductions, or bundled financial services. Market-based pricing adjusts deposit rates according to prevailing market conditions, competitor offerings, and liquidity demands. The topic highlights that pricing strategies must account for customer sensitivity to interest rate changes because depositors increasingly compare returns across banks and financial products. Institutions also analyze deposit elasticity, which measures how deposit balances respond to changing interest rates. Understanding customer behavior enables banks to optimize funding costs while maintaining competitive positioning and customer retention within evolving financial markets. The topic further discusses the challenges associated with managing deposit pricing in changing economic and regulatory environments. Rising interest rates can increase funding costs rapidly as customers demand higher returns or shift balances into alternative investments. Conversely, low interest rate environments may compress bank profitability because institutions struggle to reduce deposit rates below certain levels. Competitive pressures from money market funds, digital banking platforms, and non-bank financial institutions further intensify pricing challenges. The topic emphasizes that poor pricing strategies can lead to unstable funding structures, declining profitability, or customer attrition. Effective pricing therefore requires continuous monitoring of market conditions, customer preferences, and balance sheet objectives. Topic also examines the challenges financial institutions face when offering deposit accounts in increasingly competitive and regulated financial markets. One significant challenge involves maintaining profitability while meeting customer expectations for convenience, digital access, and attractive interest rates. Technological advancements have increased customer mobility, allowing depositors to transfer funds quickly among institutions seeking better rates or services. This increases competition and reduces customer loyalty compared to traditional banking relationships. The topic explains that banks must invest heavily in technology, cybersecurity, compliance systems, and customer service infrastructure to remain competitive while protecting depositor confidence and maintaining operational efficiency within rapidly evolving financial environments. Another important challenge involves regulatory compliance and liquidity management associated with deposit accounts. Financial institutions must comply with reserve requirements, consumer protection laws, anti-money laundering regulations, and liquidity standards established by regulators. Deposit insurance frameworks also influence depositor confidence and institutional funding stability. At the same time, banks must manage liquidity risks arising from unexpected deposit withdrawals or changing customer behavior during economic stress.